I remember watching a friend in early 2021, let's call him Dan. Dan was riding high after catching Tesla's big 2020 surge. His account was up triple digits. He told me, "This stock is bulletproof. It's Tesla." But the market doesn't care about bulletproof. In February, it dipped 10%. He shrugged. Another 15%? He called it a discount. By the time it was down 40%, he stopped answering my calls. I finally reached him weeks later. His voice was flat. "Ben, I'm down 60%. I can't sell now. I'd be locking in the loss." Here's the painful truth. The loss was already locked in. The only question left was how much deeper it would go. This wasn't about Tesla. It was about the universal trader's trap, refusing to cut losers and letting hope run instead of profits. A trap that wipes out more accounts than bad analysis ever will. Today, I'm going to show you the 4 rules Larry Hite used to beat the odds in markets and in life, and how they can keep you from ending up in Dan's position. If you apply them, you can lose small, win big, and survive long enough for the odds to finally work in your favor. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence, because in the market your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. The lessons I'm sharing with you today come from one of my favorite trading books, The Rule: How I Beat the Odds in the Markets and Life, and How You Can Too, by Larry Hite. Hite built his fortune not by predicting the future, but by managing risk so well that the odds eventually bent in his favor. And his 4 rules work just as well outside the markets as they do inside. Years ago, I was in a position that looked like a sure thing. It was a small-cap biotech working on a breakthrough cancer drug. The trial results were due in a few months, and every analyst report I read made it sound like a done deal. I took a position that was big for me at the time. But a month later, a strange thing happened. The stock began to drift lower. No big news, just a slow slide. I told myself it was nothing, probably just market noise. Another few weeks passed, and it dropped again. By now, I was down about 12%. My gut said, "It's still gonna bounce, you've done your research." But my rules said, "Cut it." I remember staring at my trading screen that morning, finger hovering over the sell button. It's funny how a simple click can feel like a mountain to climb when ego is in the way. I sold, locked in the loss. It stung, but the moment I closed the position, I felt a wave of relief. 2 weeks later, the trial results came out. The drug failed. The stock collapsed over 70% in a single day. That one decision, selling when it felt hardest, didn't make me rich, but it kept me in the game. It protected my capital for the next trade. And that's the point. In trading, survival always comes before success. You can't win the game if you've already lost all your chips. It's not about being right all the time. It's about making sure your wrong calls don't take you out of the market entirely. That biotech trade taught me something I've carried into every market since. It's not the winning trades that keep you alive. It's how small you keep the losing ones. Larry Hite built an entire career on this truth. He didn't try to guess the future. He didn't need to. He focused on managing risk so precisely that even a string of losses couldn't knock him out of the game. And that's what we're talking about today. 4 rules that can protect you from catastrophic losses, position you for outsized wins, and, most importantly, keep you trading long enough for the odds to tilt your way. But before we go deeper, a quick note. Nothing I share here is about predicting markets. There are no magic signals, no can't-miss setups. What I'm talking about is a mindset and a process, one that applies as much to your career, relationships, and daily decisions as it does to your trading account. Because when you learn to think in probabilities and protect your downside, the upside has room to surprise you. I like to think of trading as sailing. The wind is the market, unpredictable, sometimes calm, sometimes violent. You can't control where it blows. But you can control your sails, your course, and how much you expose yourself to the storm. If you stay afloat long enough, there will be days when the wind carries you farther than you ever imagined. The first rule is simple: but it's the one most people never get past. You can't win if you don't play. Larry Hite put it bluntly, you've got to be in it to win it, and if you don't bet, you can't win. It sounds obvious. But after mentoring traders for years, I can tell you this. The graveyard of missed opportunities is bigger than the graveyard of bad trades. I once had a friend, we'll call him Mike, who spent nearly all of 2020 sitting on the sidelines. He'd been burned in the 2008 crash and swore he'd never be caught again. When the pandemic hit and the market tanked in March, Mike started researching. He read balance sheets, he watched hours of YouTube analysis, he made watch lists. But he never clicked buy. He wanted the perfect entry, the perfect certainty. And while he waited, the S&P 500 staged one of the fastest recoveries in history. By August, many of the stocks he had on his list were already up 50%, 80%, even over 100%. Mike said, "It's too late now," and kept waiting for the right pullback. It never came. Here's the thing, getting in the game doesn't mean jumping in blind. It means taking calculated risks when the odds are in your favor. It means accepting that you'll never have perfect information and you'll never be certain. In behavioral finance, there's a concept called action bias. Studies show that in situations of uncertainty, people who take deliberate action, even with incomplete information, are more likely to achieve positive results over time than those who stay frozen. One meta-analysis found that, in competitive decision environments, delayed action often carried higher opportunity costs than calculated early action. This doesn't just apply to markets. Think about it. The perfect job offer isn't coming to knock on your door. The ideal relationship isn't just going to appear in your living room. You have to put yourself where the game is being played. In trading, that means having your account funded, knowing your entry triggers in advance, accepting that the first step might feel uncomfortable. It also means redefining loss. When you take a small, controlled loss as part of your system, that's not failure. That's the price of admission to future opportunities. Hite said, all major fortunes are built on a lot of small losses paving the way to big wins. If you're not willing to take those small hits, you'll never give yourself the chance to catch the big move. Now, I'm not saying get in just for the sake of action. Jumping into trades without a plan is gambling. Getting in the game means you've done your homework, you know your risk per trade, and you're ready to execute without hesitation when your setup appears. Ask yourself this: where in my trading am I standing on the sidelines, waiting for perfection? What's the smallest, safest way I can step into the game today? Because if you never take that first step, the rest of the rules won't matter. The second rule sounds like common sense, but it's the one people ignore right before they blow up their accounts. Don't lose all your chips. Because once they're gone, the game's over. Larry Hite built his career around this. At his firm, they never risked more than 1% of total equity on a single trade. That meant even if they were wrong 10 times in a row, which happened, they were still in the game. I've seen the opposite too many times. A friend of mine, Sam, got into crypto in 2021. He had some early wins in altcoins and decided to size up. He put more than half his account into a small project right before a major conference. He was convinced the hype would push it higher. But the project's announcement was a flop. Within hours, the token dropped 40%. Sam doubled down, thinking he could average down and get back to even faster. By the end of the week, his account was down over 70%. That one position destroyed 2 years of savings. This isn't just bad luck, it's a psychological trap, loss aversion. We feel the pain of losses about twice as strongly as we feel the pleasure of equivalent gains. And that pain pushes us to make irrational bets to get it back quickly. In 1979, psychologists Daniel Kahneman and Amos Tversky quantified this in their prospect theory research. Their findings showed that people are willing to take much larger risks to avoid losses than they would to achieve gains. In trading, that's deadly. So, how do you protect your chips? 1. Define your maximum loss per trade. For me, that's 1% of my total account. It's small enough that even a string of bad trades won't cripple me. 2. Use worst-case scenarios as your baseline. Before you enter, ask, if this goes wrong, what's the absolute most I could lose? If you can't live with that number, you don't take the trade. 3. Diversify intelligently. Hite traded in dozens of markets at once. Today, we have even more tools: stocks, ETFs, futures, options, crypto. But diversification only works if your positions aren't just correlated versions of the same bet. The truth is, the biggest risk in trading isn't missing out on a move. It's taking yourself out of the game entirely because of one bad decision. When you risk small, you buy yourself time. Time to let the odds play out. Time to recover from losing streaks. Time to be present for the big win when it finally comes. Ask yourself, what's the maximum percentage of my capital I'm willing to lose on a single trade? Have I ever actually calculated it, or am I guessing? Because surviving the downswings isn't just good money management, it's the foundation for every win you'll ever have. The third rule is where most traders get tripped up. They think their job is to predict the market. It's not. Your job is to understand the odds and bet accordingly. Larry Hite refused to base trades on predictions. He said there's too much uncertainty to make bold forecasts about where markets are headed. Instead, he looked at observable facts, price action, volatility, historical probabilities, and decided whether the risk was worth the potential reward. I had a friend, Alex, who loved making calls. He'd say, "This stock is going to 100 buy next month. I can feel it." He was right sometimes. But when he was wrong, he was often very wrong, because his bets were sized as if his prediction was a guarantee. One time, he loaded up on a tech stock after a strong earnings report. The odds seemed in his favor if you ignored the fact that it had already doubled in the last 6 months and was sitting at major resistance. A week later, a broader market sell-off hit. The stock dropped 20% and his account took a huge hit. The problem wasn't the trade idea, it was the lack of probabilistic thinking. In behavioral finance, there's a skill called calibrated confidence. A study from the University of Chicago found that when traders were asked to assign probabilities to their predictions, the most successful ones consistently estimated within 5 to 10% of the actual outcome. They didn't need to be perfect. They just needed to know when they were operating at 60% odds versus 20%. Here's how to bring this into your own trading. 1. Base your decisions on measurable factors. Don't trade because it feels right. Trade because you have quantifiable reasons. Past performance in similar setups, risk-reward ratios, volatility ranges. 2. Think in ranges, not absolutes. Instead of saying, "This stock will go up," think, "There's a 65% chance it reaches my target within 3 weeks, and a 35% chance it hits my stop before then." 3. Let the odds dictate your bet size. If the probability is lower, your position size should be smaller. If it's higher, you can scale in, but still within your overall risk rules. Knowing the odds doesn't mean you'll win every trade. It means you'll win enough of them with enough discipline that over time your account grows. Ask yourself, am I sizing my trades based on probabilities or emotions? Do I actually track how often my setups win and by how much? Because in trading, the goal isn't to be right, it's to be profitable. If you only remember one thing from Larry Hite's philosophy, make it this: cut your losers quickly. Let your winners run. It's deceptively simple and brutally hard in real life. Our brains aren't wired for it. Psychologists call it the sunk cost fallacy. Once we've invested time, money, or energy into something, we feel compelled to stick with it, even when every signal says it's time to get out. Years ago, I ignored that rule. I bought shares of a biotech company after it made a big run. I told myself, this thing has more room to go. But the next week, it dropped 8%. I didn't sell. Then it fell 15%. I told myself I'd hold until it got back to my entry. It never did. The drug failed its trial, and the stock collapsed 70% in one day. Compare that to a different trade I took the same year, a simple index ETF I bought during a market pullback. It started climbing, slowly at first, then steadily higher. I had no reason to sell, so I didn't. I rode that position for over a year, and it became one of my best percentage gains ever. The difference? In the losing trade, I was emotionally attached. In the winning trade, I followed my plan. Hite said, letting the winners run means you don't need to sell until your stop loss tells you to. Enjoy the ride. But don't be attached emotionally to a great investment that made you a lot of money if the market tells you to sell. Here's how you can apply it. 1. Predefine your exit before you enter. Have both a stop loss and a trailing exit for winners. That way, you're never making sell decisions in the heat of the moment. 2. Treat losses as tuition. They're the price of learning and staying in the game. 3. Review your trades. How many of your winners did you cut too soon? How many losers did you let run too long? Behavioral finance research from MIT shows that individual traders are 50% more likely to sell winners than losers, even though the losers continue to underperform. Why? Because locking in a win feels good and locking in a loss hurts. But in the markets, feelings are expensive. Process is profitable. Ask yourself, am I holding this because it still fits my plan, or because I don't want to admit I'm wrong? Do I have a system for letting my winners breathe? Because in the long run, your small losses will fade, and your big winners will define your success. These 4 rules aren't just trading folklore, they're backed by decades of research and history. Let's start with loss aversion. Kahneman and Tversky's prospect theory showed we feel the pain of losses about twice as strongly as the pleasure of equivalent gains. That's why cutting losers quickly feels so unnatural, our brains are fighting it. But in trading, refusing to take the loss early often makes it far bigger later. Hite's 1% risk rule also mirrors the survival math in professional gambling. Casino players who bet small relative to their bankroll can withstand long losing streaks and still recover. The same math applies to trading accounts. If you keep risk per trade small, you buy yourself time for the probabilities to work in your favor. And history has plenty of market reminders. Apple in 2003, down more than 30% before becoming a generational winner. If you'd sized it small and held, you could have caught a life-changing run. Enron in 2001 looked solid right until it imploded. Without a stop loss, investors saw 100% of their capital vanish. The data is clear. Survival through disciplined risk control and outsized gains from letting winners run isn't just theory, it's the only proven way to win long-term. Even when traders know the 4 rules, there are a few psychological traps that pull them off course again and again. 1. Sunk cost fallacy. Once money, time, or energy is invested, the brain resists letting go. You've put too much in to walk away, even if every rational signal says it's time to exit. This is why people ride losers down 40, 50, 70%, hoping for a rebound that never comes. 2. Overconfidence and illusion of control. A few wins can make you feel untouchable. You start increasing position sizes, taking bigger risks, and believing you can read the market. Overconfidence was one of the most common patterns I've seen before, big account blow-ups. 3. Poor risk management psychology. Even traders who understand position sizing break their own rules under pressure. They'll say, just this one time, or I have a strong feeling about this one. That's emotion sneaking in through the back door, and it's exactly when the market loves to humble you. Recognizing these traps isn't enough. You have to build habits and systems that make breaking the rules harder than following them. Because the difference between surviving and blowing up is rarely about knowledge, it's about discipline, when your emotions are screaming the opposite. Let's make this practical. Here are 2 simple tools you can put in place today to start trading like Larry Hite. 1. The 1% rule. Never risk more than 1% of your total account on a single trade. If you have 50,000, that's 500 of risk, total, from entry to stop loss. This forces you to size positions realistically and ensures even a brutal losing streak won't wipe you out. 2. Worst case scenario. Baseline before you take a trade, write down what's the absolute worst case outcome here. If that number makes your stomach turn, don't take the trade. Hite built his system around starting from the worst possible outcome and deciding if it was survivable. If it wasn't, he passed. These aren't glamorous tools. They won't make headlines in trading forums. But they will keep you in the game long enough to catch the big moves that do. Because in the end, the traders who survive the longest aren't the ones with the flashiest entries. They're the ones who protect their chips and give probability the time it needs to work. Before you make your next trade, take a moment to step back and ask yourself these 7 questions. Larry Hite used to frame every decision. Who are you? What is your goal? What game do you want to play? Where are you playing the game? What is your time and opportunity horizon? What's the worst possible thing that can happen? What will happen if you get what you want? Don't just skim these, write them down, answer them honestly. I've found that when traders pause to run through these questions, two things happen. First, they make fewer impulsive trades. Second, they enter positions with a clarity that makes it easier to stick to their plan when emotions run high. You can't control the market, but you can control how prepared you are when you step into it. And preparation isn't just about chart patterns, it's about knowing yourself as well as you know your setup. You've just learnt the 4 rules that help Larry Hite beat the odds, and how they can protect you in the markets and in life. Get in the game. Don't lose all your chips, know the odds. Cut your losers and run with your winners. Now here's your challenge. In the comments, write down which of these 4 rules you struggle with the most and what you're going to do to improve it starting today. Share this video with a friend who's stuck in a losing trade or sitting on the sidelines afraid to act. And if you found value here, hit like, subscribe, and turn on notifications so you never miss a lesson. Because your edge in the market isn't about predicting the future, it's about controlling your risk, managing your mind, and staying in the game long enough for the odds to work in your favor. Master your mind, master the market, trade with confidence, and live with calm.